This is the second lecture for Chapter 6. In this lecture, we will be looking at the inpatient psychiatric prospective payment systems and identifying the components, adjustment, and provisions of that system. The Medicare program provides benefits for inpatient psychiatric care provided to its beneficiaries. Psychiatric hospitals and units in acute care hospitals are referred to as inpatient psychiatric facilities, or IPFs, for payment purposes. The effective period each payment year is July 1 to June 30th. Prior to implementation of prospective payment systems for psychiatric hospitals and units, they were DRG exempt and were reimbursed under TEFRA Reasonable Cost Payment Scheme. The Balanced Budget Refinement Act, or BBRA, of 1999 required the development of a per-dime prospective payment system for inpatient psychiatric services that were provided in an IPF. Specifically, the BBRA charged Medicare, or CMS, with developing a classification system that would really reflect the resource consumption and therefore the cost differences among various IPFs. The implementation date was October 1st of 2002. Prior to the BBRA, CMS researched several prospective payment options for IPFs. However, its research focus was by discharge payment methodology, similar to other prospective payment systems. The research basically showed that a per-discharge system did not adequately explain the cost variations among psychiatric encounters. Therefore, a new approach had to be considered. The BBRA gave CMS a 3-year period to research and develop a per-dime system. The proposed rule was published in the Federal Register and was released on November 28th of 2003. The proposed rule outlined the new prospective payment system based on a per-dime rate with several add-on payments to provide reimbursement for those cost variations. The new prospective payment system called for major changes in the way an IPF would be reimbursed for Medicare services and discussed complex cost issues. CMS, as you can imagine, received many comments on the proposed rule. The public requested an extended period of time to review that proposal. The comment period was extended. On November 15th of 2004, the final rule for IPF PPS was released. Then the final rule established a new implementation date of April 1 of 2005. The IPF prospective payment system is based on a federal per-dime amount that represents the average daily operational, ancillary, and capital cost expended to care for Medicare beneficiaries. For fiscal year 2012, the federal per-dime amount is $685.01. Adjustments to the payment are made at facility and patient levels. A large number of payment modifications obviously creates a complex system. This payment methodology is designed to adequately reimburse facilities for the services that they provide to Medicare beneficiaries. CMS used a regression analysis model to determine the types and the levels of adjustments that were necessary to create a payment system that would explain all the cost variation among the IPFs. Regression analysis is basically a statistical method that uses an independent variable to predict the value of a dependent variable. In this case, patient demographic and length of stay were the independent variables, and they were used to predict the cost, the dependent variable. The regression analysis performed for the proposed rule in 2003 did use data from fiscal year 1999, the MedPAR file, and fiscal year 99 healthcare cost reporting information system. Patient level adjustments are made for length of stay DRGs that contain a psychiatric ICD-9 code, comorbidity conditions, treatment of older patients, and encounters that include electroconvulsive therapy, or ECT. The adjustment factor is for each day of the stay, as you can see in the table on your screen. The IPF prospective payment system will provide reimbursement for MSDRGs that contain a psychiatric ICD-9 code as identified in Chapter 5 of the Code Book as a principal diagnosis. However, the payment adjustment will be made only for 17 designated psychiatric, MSDRGs. As part of the IPF prospective payment system, there is also a comorbidity adjustment factor. This is basically for conditions that are found to cost more to treat on psychiatric patients than non-psychiatric patients. There is also an age adjustment factor. As the patient's age increases, so does the cost to treat that patient. So the regression analysis showed that the cost per day increased with the patient's age. Providing ECT to Medicare beneficiaries is very costly. The analysis showed that an encounter that included ECT is twice as expensive as one that did not include that. The cost is mostly associated with an increased length of stay, but is also a result of increased ancillary services provided. There is an add-on payment per session of ECT. The HCPCS code is listed there, as well as the 2012 rate. Next, we'll move into facility level adjustments. A facility level adjustment is provided to account for wage differences among geographical areas. The labor portion of the federal per diem rate is 70.317%. An unadjusted pre-floor, pre-reclassified inpatient prospective payment system hospital wage index is taken into account to make those adjustments. The formula is listed here. It's the federal per diem base rate times labor percent times wage index plus the federal per diem base rate times the non-labor percent. In addition to that wage index adjustment, the COLA, or cost of living adjustment, will be made for IPFs in Hawaii and Alaska. The non-labor share portion of the federal per diem rate will be adjusted by the adjustment factor provided for the county in which the facility is located. And the formula is listed on your slide. The regression analysis also showed that IPFs incurred costs 17% greater when treating patients in rural locations than when treating them in urban locations. So therefore, this is mostly for smaller facilities. There's fewer economies of scale opportunities, and the adjustment factor therefore is 1.17. If an IPF is granted a teaching hospital adjustment that will follow the IPPS model, the adjustment is based on the number of full-time residents that are at the facility. Patients who receive emergency department care before admission are more costly to treat than patients who do not receive such care. Therefore, Medicare provides an adjustment to adequately reimburse facility for this greater cost without creating an incentive to provide emergency care when it is not medically necessary to receive additional payments. A facility level adjustment is made for IPFs with full service ERs. IPFs with qualifying ERs receive a greater per diem adjustment for the first day of each stay for all patients. There are provisions. The IPF prospective payment system does provide outlier payments for high cost encounters. Outlier payments are projected to account for 2% of the total payment for that particular year. The cost of an encounter must exceed the threshold amount to qualify for one of these outlier payments. The IPF prospective payment system is designed to provide higher payment for initial days of stay to adequately reimburse facilities for the higher costs associated with a new admit. CMS has expressed concern that this adjustment could provide an incentive for facilities to prematurely discharge patients and then subsequently readmit them to receive that higher per diem rate associated with the first days of stays. So therefore, an interrupted stay provision was created. Patients discharged from an IPF who are then admitted to the same or another IPF within 3 days of the discharge from that original facility would be treated as continuous for purposes of per diem. So an example of an interrupted stay: the patient is admitted to IPF A on March 1. The patient is discharged on March 5th, so their length of stay is 4 days. The patient is then admitted to IPF B on March 7 and continues until March 10. The admission to IPF B is considered a continuation of A. Therefore, day 1 of the readmit is considered day 5 for payment purposes. Medicare provides a 9-step process for calculating an IPF payment. The first one is wage index adjustment to the labor portion of the per diem rate. Step 2, apply COLA to the non-labor portion of the per diem rate if applicable. Step 3, add the results of steps 1 and 2 together to determine the wage-adjusted per diem rate. For step 4, we will apply the following patient-level and facility-level adjustments, if applicable: rural location, teaching facility, a full-service ER, DRG, comorbid condition, and the patient's age. Determine each level of adjustment for the case. Multiply the individual adjustments to determine the prospective payment system adjustment factor. This is an example of step 4 that we just talked about. These would be all the provisions, all the adjustments. We would times those in the end and then get our final calculation of adjustments. Step 5, we would multiply the PPS adjustment factor by the wage adjusted per diem rate determined in step 3 to calculate the adjusted per diem. Step 6, whether the facility has a qualifying ER. If they do, we would choose the appropriate, that higher adjustment factor for the first day of stay. Determine the patient's length of stay and adjustment factor for each day. Step 7, we would multiply the adjusted per diem rate, that's step 5, by the length of stay adjustment factor for each day of stay to calculate the per diem payment amount. Step 8, we would sum the per diem payment amounts calculated for each day of the stay. This is a visual example for you for steps 7 and 8. And finally, in step 9, we would calculate the adjusted ECT amount for the encounter if applicable. Multiply the national payment amount by the labor share and the area wage index. Then multiply the national payment amount by the non-labor share and the applicable COLA. Sum those two products to calculate the adjusted ECT. Then multiply that adjusted ECT amount by the units of service. Finally, add the total ECT payment to the total per dime payment amount that you got for step 8. With the implementation of a prospective payment system for IPFs and units, CMS projected that Medicare will save at least $7.5 million during the first 5 years of implementation. Even though one of the primary objectives of implementation was to control costs, CMS is dedicated to maintaining a prospective payment system that not only focuses on cost and payment, but also incorporates variables such as quality and outcome measures that influence cost and payment levels. CMS will continue to research various payment methods as it makes future refinements to the system.